Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Clay Hamlin, a partner here at the firm. Clay, how do you feel about the word valuation?
Valuation is a subjective thing. You know, what's it? Beauty is in the eye of the beholder, so to speak. And so we're asked on a fairly regular basis, how would you value this business? And we have a valuation tool. We actually use this thing fairly regularly. It's not a certified valuation. We don't have those credentials. We're very good in, say, auto repair shop valuations. A fairly standard model is anywhere from 2 to 5 times what's called EBITDA, which basically translates into income. It's a fancy 5-letter, 6, whatever that is.
For something that's already really short.
Yeah, that's basically income. And then there's what they call normalized income, meaning if you pull out all the junk that a business owner was sort of pushing into the P&L that you don't necessarily need. An example, maybe an extreme example, is an auto repair shop we were asked to review recently had a airplane on the books.
Interesting choice.
I don't know exactly why an auto repair shop would need an airplane, but hey, I'm sure they've come up with a good business case for it. At least I hope. So there are expenses that are going to happen with an airplane: the fuel, the repairs, the blah 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 blah, which are buried in that P&L, and so those would be backed out as sort of owner discretionary expenses that a seller would say, hey, a buyer my business valuation shouldn't be reduced because of these, because then the buyer won't have that when they exit. Yes.
Yeah. Okay. One thing I want to bring up and really stuck with me when you're saying that it is in the eye of the beholder in many ways. Henry was on here recently and he was talking about his car. Yeah. And it's like, it's not worth, as much as it used to because it's now like 10 years old or whatever. And how the value changes, and even like the property that my land is on wasn't worth as much when I bought it. Now has gone up considerably. So the value fluctuates, and it can go up or down. And obviously, for business owners, they always want it to go up. So let's look at this from the kind of the perspective of someone who wants to buy a small business. What are some signs that they're looking are just from a very surface level to start? What are they looking for? I mean, I'm sure they're going to look at the P&L first, but is there anything like when they walk into the shop, because they want to get their eyes on it first? Yeah.
So like if I'm negotiating to buy a shop, say an auto repair shop, right? I want to know why the seller is thinking about selling. Are they aging out? Is their equipment aging out? Maybe they have some employees that are aging out. Maybe they just have sugar plums dancing in their head. Maybe they want to go retire in Florida and get mailbox money. Maybe, what is it that's driving them? Because if you don't know what's driving them, it's going to be very hard to negotiate with them, I guess the person, right? Yeah. Typically. Negotiate with the person as to what's a reasonable price. Because there's an old saying that business owners always think their business is worth a lot more than it actually is.
Because it's their baby.
At least from a cash flow perspective. And most buyers aren't really willing to pay what's called blue sky, which means sort of like, hey, if I took this over, I could make so much more money. As an example, most accounting firms trade on 1 times gross revenue. So I once looked at an accounting firm near Chicago. Their gross revenue was about $2 million, and so they said, "Well, we want $2 million for our firm." And I said, "That's fine. What's the net profit of this thing?" And it was about $25,000, and they took only a reasonable compensation for the owner. So it wasn't like, it was all taken out through
once
W-2
he's gone,
income
we're
or
going to
something.
bring in so much more. Yeah.
Well, right. And I was like, I can't even pay like a month's interest on this deal at $25,000. There's no way. I'd give you maybe $75,000 for this thing, 3x revenue or 3x profit.
Because it's not really how much they make; it's how much they're bringing in, like the excess. Yeah.
Right. So they're like, "You're going to buy us out on our own money." If it's $75,000, I'm like, yeah. All businesses are bought out on their quote
on the real money.
Yeah.
Yeah.
And so, if you think that someone's going to like just come in and write you a gigantic check, I'm not saying it doesn't happen. It's rare.
And it's becoming rare, is my understanding.
Yeah, there was a period of time when PE was delivering big checks. That's reined back because money is actually leaving PE right now. If you go in like a Wall Street Journal, you'll see, hey, money is actually leaving PE. They're writing IOUs because they don't have cash to take people who want to get out of the fund. Well, that doesn't usually lend itself to PE coming in and says, I'll write you this big check just to build market share. Not when they can't pay investors who want to leave.
Well, and I just want to go back. This is what's directly affecting valuation. Because, again, you may have a profitable place that someone was going to offer you, let's say $1 million for.
Right.
But if no one's there to offer you the $1 million, it could be worth it, but it isn't there.
Yep.
I may want to, there may be this really awesome car on the lot, but if no one's going to buy it, it doesn't matter if it was overpriced, underpriced, or right in the middle.
What's interesting is we're seeing a sort of mid-tier PE deal going on. Seeing quite a bit of this. Let me explain what that means.
Sure.
So like a few years ago, it was like the big names, BlackRock, blah blah blah, big, sort of household names were going out and fishing in the small business pond, if you will. Okay. It was driving valuations up a lot. Well, what happened then was, so they would hold it, say, for 5 to 7 years. Then they would do a second tier deal. They would sell off a basket of these companies that they bought, whether it's dental firms or auto repair or other businesses. They'd sell it off to another PE company and you get what's called the second hit or second tranche or whatever you want to call this thing. So a number of companies, say like in auto repair, were saying this. I saw this in accounting firms. I've seen this in dental. Is where somebody who is sort of big-ish in the industry starts acquiring, and they become even quite a bit bigger, so that they can they're in essence doing their own mini PE, right? So they buy some to get not only the first hit but the second hit of PE money, because they're sort of, and those players are still active, where we're seeing not nearly as much big company PE. We're seeing these sort of regional or peer sort of PE, if you will, money that's active right now and still paying, fairly decent. They're not paying the obnoxious money that happened a few years ago. I'm almost done. But they are still paying like a small amount of blue sky. So maybe they'll pay them even slightly above market to grab that market share so they can go to the sort of second round of PE money.
When they do this, do they, in essence, try to, like, I don't want to say create a monopoly, but maybe like own an area and like create a chain?
It looks that way. I mean, let's say, for example, you're in auto repair and you've got, say, 10 locations.
Okay.
That to a one location place, that looks like almost like a chain, at least a regional chain. You can get that up to, say, 40 locations. that you start to look at this going, wow, these guys have a lot. That's a large business. You're probably looking at 50, 60, 70 million dollars, depending upon their revenues. But it's going to be in that range for 40 locations. That's a good sized company. Yeah. And so would you call it a chain? I mean, it's not like Midas or Meineke or something like that, but it definitely is starting to look like a chain, sure.
Okay. I'm just curious, when you were talking about, hey, let's say they get dental firms, right? Hey, I picked up this one, They're all run by different dentists. And then they slap the same label on all of them and call it a XYZ company, and then they sell it for more.
Sure.
Okay.
Yep.
All right. Anything else we should talk about with valuation?
From a seller standpoint, so we've kind of looked at it a little bit more from the buyer standpoint. From a seller standpoint, one of the things that I would do is I would check with someone who has reasonable knowledge of the industry about your valuation.
Would a business coach, like we've just talked about, fall into that category?
Probably yes, if they're familiar with your industry.
Okay,
if
that's something you can ask.
If they're a sort of homogenized, like maybe if they're just EOS in general, for example, they wouldn't know anything more than someone else. But let's say you're in the auto repair industry and you're working with an auto repair coach, yes, they will definitely be able to give you advice like that. Accounting firms oftentimes can give fairly decent advice about this. Of course, valuation experts for $10,000 or whatever it is will give you advice on this. Mm-hmm. Their advice is going to be strictly mechanical, though. So a lot of small businesses, there isn't a lot of transactional information that happens. So, like, let's say, for example, I own an auto repair shop and you own an auto repair shop. We're both, maybe you've got like 3 bays and I got maybe 3 bays, and I buy your shop. It's not public information how much I paid for your shop.
Because we're two private companies.
Yes.
Yep.
Right. That's not public information. If you go with a listing broker, that becomes a little bit more public, and there are listing brokers that will help move shops in all different sorts of industries. But oftentimes there's what you list for and maybe what you sell for can be 2 different numbers. So it comes up of like, hey, how much should I put this thing up for? And a valuation expert is like I said, it's going to be more mechanical. So it's going to be like 3x times your seller discretionary income. So that was like the income minus the owner's personal expenses kind of thing that's in there that get added back to profit, right? So anyway, that's a whole other conversation of how you come up with that. Maybe that'd be a future Kaizen time. So how would I think about it? I would go ask some people, because oftentimes a business owner thinks that his or her business is worth a lot more than it is. And to sort of bring that down to earth, I would go and talk with people who are knowledgeable about this.
Okay. And honestly, the closer they are in proximity to you does matter. Like, hey, in your city or in your state, because those are very big factors, right? Because someone doing something in a major city versus you out in the sticks, it's completely different numbers, completely different type of people you may be dealing with.
Maybe.
Really?
Yeah, maybe. So if I'm an auto repair shop, I'm local, right? My techs are local, my customers are local, my business is local. If you look at Kaizen, though, for example, we have a national presence in the auto repair industry, and our employees are all over in 18 different states. It doesn't matter so much where our headquarters is. It could be here in Illinois, it could be in Florida, it could be in Pennsylvania, it could be in Arizona. It really doesn't matter where our business has a headquarters. Okay. because our customers are not local. So we're not really looking local, and so if their business isn't operating locally, so like our community is like auto repair, but that's auto repair across the country, not just in Antioch, Illinois.
Right. So it can very much. It is more determined by who your customers are, where they are.
Yes.
Okay.
Very much.
Cool. Anything else you want to add?
No, I think we've covered this one.
Perfect.
Thanks,
Thank
Mark.
you, Clay.
Yep.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.